Hi, Kelly Eckold here from Westpac. We've just released our new economic overview with the theme of Are We There Yet? And that theme refers to the question that's been on the tip of everybody's tongue for a while now. When is this much forecasted recovery in the economy going to materialise? We do think that the economy is recovering right now. We think that growth overall for the year is going to be 2.4%, but there's going to be a few twists and turns in the road as we register that growth. The economy overall is pretty mixed. In the agricultural sector and the parts of the country that derive from that, things are looking pretty good because export returns are pretty strong. But in the urban areas, it's a lot tougher. Businesses and consumers are waiting for those lower interest rates and stronger export returns to accrue to them. But we do retain confidence that recovery will continue, and in particular we think things like uncertainty associated with the global trade war are going to wane, and they'll give way to those structural factors that should support recovery, those lower interest rates and decent export returns. So with that in mind, let's have a closer look to how we see different parts of the economy evolve.
A big part of that "are we there yet" feeling about the recovery is that question of when are households finally going to benefit from those lower interest rates. So how are we tracking on that front?
What we've seen over the past year are some big reductions in the Reserve Bank's official cash rate. They've already cut the cash rate by 225 basis points, and we think that they're going to cut the rate again in August. Now that has seen mortgage rates falling by a large amount, but a lot of borrowers are still on those high fixed rates that were on offer in recent years. And as a result, we have seen spending remaining soft, especially given that we've also had some ongoing cost of living pressures with big increases in items like food. The good news is that over the coming months, a lot of borrowers will be refixing their mortgages, and when they do, it'll be at a much lower interest rate. That'll give them more disposable income, and we think that is going to support spending going into the new year. But there are still some challenges out there, and one of the biggest ones is that we're still seeing some softness in the labour market.
That's right. The way that I describe it is that if you're out of work, it's difficult to break into it. Now, businesses have been through a prolonged slowdown since the post-COVID heyday, and they've tried to hold on to workers where they can. And that has tempered the extent of the rise in the unemployment rate. We've just seen it rise to 5.2% in the latest quarter, but that's still on the low side of where many forecasts were thinking we'd be by this point. Now, the flip side of that has been that they have been slow to return to hiring. So while even in business surveys they say they're feeling much more confident about their prospects for the year ahead, they're still in a tough spot at the moment, and they're not really at the point where they need to start looking at hiring again. So I think we're going to continue to see the labour market lag behind that broader recovery in the economy they're expecting, and the unemployment rate likely to hit a bit higher by the end of this year before it peaks.
So business confidence is starting to pick up as we've seen those lower interest rates hitting the economy. What's happening to businesses' plans for investment spending?
Yeah, there's a bit more action happening in the investment space. The lower interest rates are helping. I think also the replacement cycle and the need to be adopting new technologies is driving a lot of that need to invest, even with current conditions still a bit tough. The government's investment boost scheme I think will also be helping at the margin, bearing in mind a lot of that is going to be applying to investments that would have probably happened anyway, are just likely to be brought forward instead.
So potentially still some soft conditions for now, but hopefully a better outlook as we go into the new year.
So Darren, what's the outlook for the global economy?
Well, Paul, despite all the uncertainty and disruption caused by the US tariff policy, things are still looking pretty good. We think our trading partners will grow about 2.7% this year and about 2.6% next year. Now that's a little less than we saw prior to the pandemic. US tariff policy will slow US growth, and China faces structural negative forces as well. So not as good as it has been, still pretty solid, and that provides good opportunities, I think, for exporters over the coming year, even with that unhelpful 15% tariff into the US. What does that mean for export prices?
Well, it's a really interesting one. Even with the 10% tariffs, we've seen commodity prices actually rise, be that beef, lamb, kiwi fruit or apples. Looking forward, even with a 15% tariff increase, we still expect basically prices to rise. And just to give you an example, beef prices have lifted or are expected to lift really on the back of constrained production out of the US, and that's not likely to change anytime soon. So we expect those prices to move higher. In terms of dairy prices, of course, they're the big one. They remain elevated, and yes, we do have built in a little bit of softness over the next year in dairy prices, but even then, we're still pretty happy with our $10 milk forecast payout. So Darren, what does that mean for the current account?
Well, it's good news. The deficit's already declined to 6% of GDP, and as those strong export revenues flow through, we should get to 4.5% of GDP by the end of this year. Now that's still a little high relative to history. We don't have the full recovery yet in the tourism sector, and the government's running a fiscal deficit. The credit rating agencies, they will be looking at concern with these twin current account and fiscal deficits, so we do need to see some improvement on those deficits, or we could face the possibility of a credit rating downgrade at some stage in the future.
So as you can see, it's a pretty mixed picture out there. There's plenty of excess capacity in the economy, but growth is on the horizon and inflation is right up at the top of the Reserve Bank's 1 to 3% target range. There's been 225 basis points of easing delivered in the last year, and that's quite a lot outside of a crisis situation, and a lot of those interest rate cuts are still to really flow through to households and businesses. We need to remember that the lags to monetary policy are famously long and variable, and that's why the wait for recovery seems so long to many of us. We think the Reserve Bank is going to be weighing up, on one hand, the needs of many parts of the economy to see some further interest rate relief. But then on the other hand, the threat that high inflation and rising inflation expectations might mean it takes a long time for inflation to ultimately get back to the 2% target. We think that on balance, they're very likely to deliver that last 25 basis point cut to 3% at the August monetary policy statement. But after that, I think they might be a bit more cagey. They'll wait and see how the data evolves over the rest of the year before deciding what to do next. I suspect that the interest rate cycle may be done, even though the Reserve Bank may be still on an easing bias for a good while yet. So that's how we see the economy evolving. For more details of our economic overview, please have a look on Westpac IQ for the full report. Thank you very much.